Interested in real estate? How about wealth? Well, they go hand in hand. And here, you'll learn all about it. Welcome to Be the Bank, a podcast where we discuss and debate the topics centered around real estate investing. Your host, Justin Bogard, shares insights into investing in real estate to create real wealth and passive income for you and your family. He'll share stories of real estate investments done right, walk you through the process of owning a real estate note, and most importantly, educate you so you can be the bank. This is Be the Bank, brought to you by American Note Buyers. Now, here's your host, Justin Bogard.
Hey, listener. This is Justin Bogard here on the Be the Bank podcast. This is season 6, episode number 5. Today, I have a person that I don't know very well, but I know who she is. And we've had conversations and we hung out before with her and her husband. And so she has a very strong background in banking and has been on the note scene for a little bit now. And she's definitely somebody that brings a lot to the table, and she's going to have a lot of cool things to talk about. We're going to focus our conversation today on kind of underwriting, as it were. So some of you may not have that skill set as a strong skill set, and so this will be a fun conversation today. So stay tuned and welcome to the show, Miss Vanessa Gomez LaGatta. Man, it's funny when you start talking in these podcasts and all of a sudden you get something in your throat and you're just like, wow, this is the wrong time to clear my throat.
I hear you. I have a glass of water just in case.
Yeah. I had to grab something a little bit warm before we got on the show today, just because today it's not cool, but it's like, I don't know, dreary. It's like dark and cloudy. And I don't know, you feel cold, even though it's not cold outside. It's actually like 65 degrees outside.
Oh, wow. Well, we're actually in Vegas at the Structured Finance Vegas conference. So it's a little chilly outside, surprisingly.
Vegas, baby. That's what I think of every time someone says Vegas. Vegas, baby.
It's been good. It's been good.
Awesome. Well, thanks for being on the podcast today. I know this is your first time being on our show, but probably not on others. I'm sure you've been on other podcasts before. But Vanessa, the audience that we have here today, they don't know you. And they would like to know you, and just I wanted to set the table a little bit and kind of let us know kind of your background and how you kind of got into seller financing notes. And then we're just going to carry on the conversation from there.
Oh, no, sounds great. But first, thank you for having me on the podcast, Justin. I'm excited to be here today and just share a little bit about my background. So I started my career at Credit Suisse, which is a bulge bracket shop, rising up to director in the investment banking division and focusing on leverage finance. What I worked on were large, complex leverage facilities for financial sponsors and corporates throughout the United States. I did have a specialty in the energy space. From there, I went to go work for an energy public company, moving to Texas from New York City. And from there, it was a very active company. We did a lot of complex M&A transactions, as well as tapping the capital markets. And ultimately, I took over as CFO until we sold the company a couple years later after becoming CFO. Then I did a little stint in the turnaround restructuring space. And then I joined another energy related company as CFO, and I took them and helped them emerge out of bankruptcy. Go ahead. Sorry.
I was to say that question, you say energy, and I'm making assumptions here, but specifically, What are you talking about in energy? Is this like gas, electric, water type energy? Like what?
Absolutely. So it's called an exploration and production company. So what we did is we drilled wells into the ground and extracted gas and oil. The company I work for specifically was more gas weighted than oil weighted. And we had production in Texas, some in Colorado, Canada, and some up in Alaska.
Yeah, Texas definitely makes sense. Drilling, right?
There's a lot of drilling, especially around the DFW area.
You know, I've been to Dallas many times. I know you have too, and you live close to there. But I never see any oil rigs or wells until I get like really far away from the city if I'm driving, somewhere else or going to a different location. But you actually see them like in the Dallas metro area?
Oh, yeah. So if you drive actually from Dallas to Fort Worth off of 30, there's different wells that you can see. And what you'll see, no, you won't see the drilling rig anymore. You'll just see the pad that has all the production equipment that is the result of the wells being drilled. But there's production all over the metro area. And what's interesting is, in the energy space, they've gotten more and more sophisticated as the years have gone by. It's been now several years since I worked in an oil and gas company. But what they do is they drill laterally. So they drill down and diagonally, and they can go for miles upon miles. And so you can actually reach quite extensive under residential homes or businesses, lakes, etc. And so it's actually it's very sophisticated and complex. And I don't necessarily think the media talks about like the technology behind it, but it's pretty impressive.
It sounds amazing. It just still fascinates me that there's oil underground and we haven't ran out of it yet. We keep tapping into with all these countries that always are going after the oil. It's just fascinating to me. I'm sorry, I jumped in and didn't let you finish your history here.
No, so after my stint in a couple of public companies, I decided I wanted a different kind of challenge, and so we started an investment platform, which is Olive Cove Partners. And it's an investment platform that invests in opportunistically. And our real investment strategy is deploying capital in downside protected assets with equity-like returns or attractive risk-adjusted returns. So that really started in earnest about 3.5 years ago. Shortly after kicking off the platform, Mike left his corporate world and joined. And now we've both been active in investing in the single family space, as well as, and in that space, we originate and buy private money loans, and then as well as investing in the secondary residential mortgage loan pools,
Awesome.
which has been more recently our big focus.
So you mentioned downside on the type of investments that you go for. What is the main downside that you're looking for in an investment?
So what we look at for investment, and I'll use real estate because it's a good example, right? So right now there's 84 million mortgages in the U.S.
Mm-hmm.
Those mortgages have a debt of $12 trillion. And then if you look at the value associated with all of those, if you look at the average home price in the US, what you find is that the loan to value in single family residential is almost 50% loan to value. And so when you take a step back and you think about this asset can lose 50% of its value before the lenders start experiencing pressure on getting their capital back, there's a lot of cushion there. And then in particular on buying in the secondary loan market, we don't buy at par, we buy at a discount to par. So our investment to the amount of capital that we've deployed based on the value is even lower than the loan to value. And so there's even further protection from that. And that's very attractive for us.
You said that very well, and I don't know why more people don't get into real estate just for that reason, whether they don't get in the notes specifically or not. But that's just a great way to put it, Vanessa.
Absolutely. It's when you talk to people and you explain it to them, just as I just did now, they're like, "Oh, that's super interesting."
Yeah.
And I don't think people really put two and two together. Because there's so much equity value in the residential market space right now, we're also seeing a lot of new products coming to market, which is very interesting too.
I think what rings a bell in people's ears, the way that you said it, which I like the way that you said it, is the 50% loan to value already right there. So like, oh, so this thing is worth $100,000. The borrower has $50,000 of equity, but you're not paying $50,000 for the note. Like, no. So overall, you're your investment to value is is significantly lower risk than what you think when you're investing in just a traditional property. And let's say you get the property for 85 cents on the dollar if you buy it straight out from that person, at a discount. Our discount's much different because we're levered off of the unpaid balance as opposed to the actual property value. So it's just really cool way you put it. I haven't heard somebody put it that way, so I like it.
Oh, well, thank you. It's what makes us attracted to the space. So
Absolutely. It's fun. So you and Mike are running this investment company, and are you raising private capital as well?
So to date, we've done all our investments based on principal capital. As we continue to grow, buying larger and more pools, we would look to partner with other investment platforms, family offices, et cetera, to be able to kind of expand what we are just the number of pools that we can buy. So right now, to date, we've done all principal capital, and we're open to the conversation of partnering with people to co-invest on these pools.
That's really where you make a big hit against taking down a tape, is when you can partner with people and take down bigger loan amounts, as opposed to, since I've been started out, I typically am buying loans around the 30,000 to about the 100,000 range. And since I started the fund last year, that's really what I've been able to look at assets, higher than 100K in value and be like, oh, I can buy 2 or 3 of these now, and not just, focus on, well, if I bought that one, I'd be tapped if I bought one loan, right? So it's a different ball game when you can buy in bulk and also in higher and unpaid balance value.
Well, so for example, we're looking at a tape right now that has 18 loans, kind of UPB. I'm just going to use round numbers, about $4 million, looking at probably a purchase price of, somewhere between, I'm just going to say $3 million. And it's 18 loans. And the average UPB on that is around $230,000.
Yeah. Doesn't sound like a lot of loans.
There's some high dollar loans in the pool. But that's also where I think there's opportunity to be able to, take down a little bit bigger pools, because there's a lot of people who play in the smaller balance space, and where you get above that $150,000 UPB, not everybody can play in that space, and it provides an opportunity for us to be able to come in and play.
You mentioned earlier about private money loans. Did I hear you say hard money loans? Is that one of the types of loans that you guys like to go after?
So we originate private money loans, and we also will buy private money loans that other people have originated. So we will do the primary and we'll play the secondary space in that specific asset class.
I'm going to get in the weeds here. So are you,
okay?
I'm talking about like a fix and flip type of loan, to where they're borrowing money on a short-term basis with the intention of either renegotiating the terms with you for a full amortization of 30 years, or selling the property and paying off the interest-only debt. Is that the type of loan that I'm hearing, the private money that you're saying?
So it's a little bit of a combination. So when I originate a private money loan, it's usually for, let's just say, a fix and flip. I do new construction and I do land development as well. But let's just take the fix and flip, because I think it's a perfect example. Those are I do 6-month deals, right? So the tenor is 6 months. Generally, my rates are somewhere between 10 and 12% on an annual basis, and then origination fees between 2 and 4%. And I call them operators or sponsors, come in. We fund the purchase price as well as the rehab, because we like to be 100% of the capital structure. That allows us to kind of have a good sense of, where they are in the project, how the rehab is actually progressing. And then once the rehab's done, then it hits the market. And usually our operators are very efficient. They have very defined scopes of work, very defined timelines. And so when we go into a deal, we actually know what everything's supposed to look like. And everything, nothing's ever perfect. Things go wrong, but just given that there's a goals and objectives and posts that we check in on, it makes the process very efficient, and our operators are very good at executing. I've had deals that go. Sorry, go ahead.
No, that was a delay there. Sorry, finish what you were going to say.
I was going to say, we have operators that come in, and there are, extensive rehabs that take, call it several months to get done. And then we have some that are more cosmetic in nature and they're in and out in 2 weeks and put it back on the market. So we kind of see everything, from super fast rehab to getting it back on the market to a little bit more extensive types of rehabs. And then it taking closer to the full 6 months. And depending on the situation, we might go a little bit longer. And we just discuss that up front.
Okay. What type of skin in the game does your borrower have with these specific loans?
Great question. So it really depends on the ARV and where they are buying the loan. We like to have a loan to value of around mid 70s and below. What I would also say though is that we really, a lot of our operators don't have a lot of cash. And so expecting there to be a huge check of skin in the game and have them pay, monthly interest, I think is unrealistic. And so a lot of times we really end up partnering up with operators who are able to buy the properties at very attractive rates to the ARV.
Gotcha. Okay. What experience level do you require of these operators or sponsors to do these projects and to get loans with you?
So we are not the lender for everybody. We are not, we don't go around and, I don't do a ton of marketing. Really, people who come to us are through word of mouth. And because it's through word of mouth, people who we have done business with know our diligence approach, as well as what we look for in projects. And so as our names get out there and people meet and are introduced to us, they also kind of understand what they're getting into. And so we look for operators to have some experience in the space. We look for them to have, what's most important is that either they themselves are doing the work or that they have teams that they've worked with and done projects before. That's a really big one for us, because finding good service providers, the trades out there that actually complete the work and do a good job is harder than you would think, and somebody who can then get the job done in a timely fashion. So that's but so we look for people who have done a couple of projects before, who have the service providers to be able to get the jobs done. And at the end of the day, we talk to everybody, whether it's on the phone call, Zoom, we prefer Zoom, or in person. And we really for honest, hardworking people. And we really look them reaching financial goals, right? So, sorry,
Vanessa, are you still there?
As if yeah, sorry, it was coming in and out. I'm at a hotel.
Yeah, that's okay.
I'm here.
I think, I figure your Wi-Fi is probably spotty at times. I think that if I could paraphrase what you were saying, you're looking for people that just are honest and transparent. They're hardworking, and they just, that they're going to get the job done. My follow-up question to that was going to be, do you let them do multiple projects with you or with other lenders at the same time? And if yes, how many do you allow them to do? Because I'm sure at some point they get strung out as far as, they're burning the candle at both ends, so to speak. And do you recognize that point?
Absolutely. That's something we talk about up front, right? So when we're talking, no, I can hear me.
Okay. Yeah.
Can you hear me?
Uh-huh.
Okay. Sorry about that. So that is one of the questions when we are first being introduced to new sponsors. We ask them, like, how many projects can you take on at one time? Where do you think you would be at full capacity? And then also understanding the type of projects that they are on. So for example, if they're doing all new construction, that's a lot more intense type of work. And I know that they're not going to be able to handle, call it 10 projects at one time. If they're rehabs, they're across the street. Okay, you can do a lot more than of those.
Yeah.
And so it's really situational at the end of the day. And a lot of times my borrowers, I'm doing a lot of their projects. They like our approach. They like our diligence. And what I was trying to say a little bit earlier is that, yes, we are the private money lender, but we really look at it as we are your financing partner. I put on my chief investment officer hat on, and I walk through the projects with him. I show him how I've calculated my numbers and what their returns would look like on their base case from an ARV perspective. I run downside cases and I run upside cases. And I'm like, this is what the numbers look like. Is there enough for you to feel engaged enough on this project? And so we have those discussions. And one of my biggest things is we want to make sure that there's enough juice for them at the end of the day to stay focused.
Yeah, I like the way that you approach the private the private money, the / hard money, way you originate the loans. And quite frankly, I don't think a lot of lenders do the extensive diligence that they need to. Some of these newer fix and flip folks come into our space and they look at lenders and they're like scratching their head going like, why are their rates so high? Why are they asking for such low LTVs? And for all the reasons that you explain your diligence with underwriting these projects is exactly the reason why, because you have to protect yourself, especially when you're doing many of these loans at the same time, because they can all start going bad, especially if they're in the same concentrated area and the real estate kind of flips upside down for a little bit. You definitely want to give yourself some protection. So if you guys are out there thinking about doing hard money loans, the way that Vanessa is describing it, the way that she walks through it is the way that's like the baseline. Like you need to also find ways to make sure that to protect yourself in other ways too, for your whole portfolio. So yeah, I really don't think a lot of lenders are as diligent as you guys are.
Well, that's something we pride ourselves on. And that's what I say. We're not the lender for everybody, because if our partners don't see the value in our diligence approach and how thorough we are, then ultimately we know when something goes wrong, we're not going to probably have a rational conversation at the end of the day to try to find a solution. And we've had some interesting things happen over the years. And what we found is that our borrowers have been very rational. And as a result, we have been rational back, right? It is not all about us just being the lender and saying you have to only abide by the terms on the paper. We're going to come up with a solution that works for everybody, because one of our biggest things is we want repeat borrowers. We want people that understand our underwriting process. We want people that we trust, and so let's do it again and again and again. And if our borrowers see us as just transactional, that's not, we want relationship-based borrowers, and that's really important to us.
Yeah, you said it before I said it out loud, but I was thinking the same thing you were. It's a repeat customer. Once you set up a repeat customer, that becomes a profitable customer, because it's far less time to interview them in the beginning. You can skip a lot of that stuff up front and go straight to the project and get to the meat of the numbers and go, okay, yes, this one works, this one doesn't. And then you have a track record with that person and be like, yeah, I know they've done a couple of deals. But they did a couple of deals with me. It's different than them just doing a couple of deals, in general with a couple of other people. So I fully agree with the way you approach that.
It makes a difference. I just had a borrower. We did a deal in early 2022. The deal went well. Everything went good. Hadn't heard from him in a while. And then all of a sudden I get a phone call, text message, email. I have a deal. Are you still lending money? Can you act quickly? I'm like, absolutely. You know what I do? Let's send me the information and let's go to it. And they reached out to me Thursday evening. By Friday morning, I already had a commitment letter out to them.
That's
so
really
they were
quick.
they were able to send to their, seller so that they can, agree to the terms and get the truck contract signed. So that's a bit of that relationship, right? And that we can move more quickly than most. And as a result, people find value in that.
Absolutely. I'm sure you guys also originate just owner-occupied homes as well.
Not as much, just because we are the private lender. We don't take ownership of the homes, but when things don't go right, and they do, we have taken possession of homes, and once we take possession of the homes, doing seller finance is clearly one strategy that we employ and have done so.
What do you typically like to see on a seller finance deal where it's owner occupied for skin in the game?
So at least 10%. But what I would also say is that we try to be creative as well, right? One of the things that I think the seller finance market, right, is they're non-qualified people, right? They can't go to the bank and go get a loan. And so a lot of times those are business owners of trades and everything. And for us, we like that borrower. Why?
Yeah.
Because they're hardworking, they're honest people, right? That goes back to, the same people we support on the origination side. And so from that perspective, we like to see that they have a consistency of jobs. We like to see who's living in the house.
Yeah.
And then we also like to see, is there family around? Do they have family in the city that they're in? Telling us a little bit more about who the borrower is. And then from just a pure financial perspective, we usually see financial statements from or bank account statements from their business and then personally. And the other thing that we find, we don't necessarily, because we don't do a ton of these, I don't have them RMLO'd, but we do have them serviced. And I think that's really critical from a servicing perspective to have it professionally serviced. I still reach out to our borrowers when they haven't paid, but having the servicer there is really critical.
What is the
Oh,
fastest?
sorry.
What?
One other thing I do want to highlight. So a lot of times, because these individuals do not have consistency, we go into it knowing that it's not going to be as steady as a normal, qualified mortgage.
Yeah.
And so what we look to do is also see what other assets can they pledge in support of the loan. So
Okay.
for example, on one of our homes, they were going to finish the rehab on the house and they were going to live in their RV that they were able to get connected at the home. So we have title to the RV as well as a mortgage filed.
Makes sense.
And it was just an extra support. And because the person couldn't put down as much as we wanted, we took that, we structured it as a first and second lien. The RV supports both liens, but the intent is that when they're done with the home on the renovation, they've moved in, is to sell the RV and those proceeds would pay off the second lien.
Makes sense.
And then
Always
we'd
got
be
to
at
be
a
thinking
normal
about extra assets, right?
extra assets all the time. And don't forget to get those to get those titles on those vehicles and RVs, motorcycles, etc.
Oh yeah,
It
definitely.
needs to be in your possession.
What I was going to ask is, I'm curious to know, what is the fastest on your private money loans that you do for your fix and flippers? What's the fastest that you've ever had it funded and then back to you, completed, matured?
Actually, I had one last week. I sent money out on Wednesday and got repaid on Friday.
So that's almost like a transactional money at that point, right?
It is. That was transaction, but I've also done many deals with these borrowers, and they had somebody on the back end to buy it, and they just needed it was effectively a back to back. But the title company required them to close fully on the purchase, and then have a day. And then have the second closing a day after. And so the title company was really driving why it wasn't actually a same day transaction. Outside of that, I've had some land that we funded, and that closed, call it early December, and by end of December, I had been paid off.
That's pretty cool.
It can go quickly.
That business in general is something I kind of wanted to tinker with. Richard and I had done a couple of deals like that before, and we was looking at ourselves like, man, I wish we could have like 5 or 6 of these lined up every month and just be in and out in a couple of days. That's like a lender's dream right there.
It is, but I would also say it's 90, let's call it 5% of the portfolio, right? Like most of it is not that way. And I would also say that these are repeat borrowers, right? So some of these are sizes that I normally don't play in, right? But they bought the house. It was essentially, you're really buying the land. and to flip it. And so
Yeah.
those aren't the types of transactions that we normally lend on, but it's relationship based. And our borrowers come in and say, hey, would you do this? Of course, let's do it. And actually we are quite supportive. A lot of times they come in and they say, we have a contract. I've done this with one of the borrowers where they got a contract. We talked about what it would take to do the rehab. And they said, will you give us a month to see if we can sell it? Because we have too many projects and we'd like to see if we could just do what's called a hold it. And so what we did is, again, we try to be creative from a structuring perspective. So what we said is for the first month, try to sell it. And if you don't sell it, then we'll kick in the rehab loan at that point, and then we'll go from there. Still keeping the 6 months, right? So the rehab had to be something done quickly. Ultimately, they had thought they had a buyer within the month. They fell through right at the end of the month, and then we flipped into the rehab portion of the loan, and they're actually working on it right now. And I should be getting my last draw request on that probably this week. And so we try to be creative, and that's where that relationship aspect is super important. Listening to what our borrowers need, and then thinking, how can we be responsive that makes it a win-win for everybody.
Vanessa, quickly, where are you doing these rehabs at? Is it just basically at a DFW or?
It's a great question. So we are in the DFW area. That's where we live. And we like the DFW area. So a lot of our operators are in the DFW area, but we will do private money loans throughout the state of Texas.
Okay. And then how can we get a hold of you guys?
So I can share my contact information, but the best is to email operations@olive-cove.com. That reaches everybody on the team, and just to make sure that we get back to you guys.
So that was operations at olive-cove.com.
That's exactly right.
All right, olivecove.com. All right, Vanessa, we are out of time today. Thank you so much for being on the podcast. This is episode number 5, season 6 of the Be the Bank podcast. My gosh, my tongue is all tied today. So thanks for being on. This has been an awesome little conversation today, and I really enjoyed the private money conversation that we had on the underwriting. That was pretty fun.
Absolutely. Thank you for having me. It's been fun.
All right, you're welcome. We'll catch you guys on the next episode if I can get my mouth to work correctly. Oh, there we go. All right, see you guys.
Bye. Thank you.
Thanks for listening to Be the Bank. We hope you learned something from today's show. If you enjoyed this episode, please rate and review us. Plus, check out our channel on YouTube and follow us on Facebook and Twitter at Be the Bank and on Instagram at Be the Bank Podcast. Be the Bank is sponsored by American Note Buyers. Thanks again for listening.